Okay, and you have to accept that. And then let's go ahead and put up the PDF. And let me gently put it into tablet mode. That doesn't sound good. I'm going to have to go through that fire drill. Doesn't seem to be any reason for it, but it does happen. Okay, not too bad. Okay, all right, good. So let's go ahead and let's take a look at the table of contents for tonight. And we're going to spend some time talking about professional standards. And that is not a terribly heavy area, and that the examiners don't ask a lot of multiple choice questions asking about these standards and the way they're organized and whatnot. However, some of the conversation you heard at the start of class, there's always at least one research question in your task-based simulation. And so when you practice with your research homework, you'll get a chance to do some of the searching and whatnot of the various standards. But questions that focus directly on the organization of the standards are fairly light. Okay. Then we're going to come down, we're going to talk about different types of engagements and stuff, but that's more of an overview than anything. But you come down and you can see that we're going to be focusing quite a bit on reports. Okay. Reports have long been a heavy area on the exam, so you can expect at least 10 points there. You can expect a fair number of multiple choice questions. I can all but guarantee you that you're going to have a task within one of the task-based simulations that is going to expect you to, look at a report and respond to questions about that report, etc. The way they often do this, and I'll talk more about this, is they'll say something like, your staff wrote the audit report and you are to give them comments, or somebody else gave them comments. Tell us what you think about the comments that were given. So what I have found is the best way to get around that is to have you be so familiar with that report content, almost having the entire thing memorized, that a question like that becomes very simple for you to address, and will probably be one of your stronger areas, the way we're going to approach that. So that's 10 points. Subsequent events is probably about 5 points on the exam. Other supplementary information and special purpose other country frameworks, I'm going to put 3 points for each of those. You might get 1, 2 multiple choice questions on that. Okay. Okay, good. So that's just to give you a sense. And again, that is, please don't take this to mean that you should not study these lighter point areas, but it's just to give you some expectation as to how much of a particular thing you're going to see. Obviously, the centerpiece for chapter 1 is the reports, and you got to be ready for that. Okay. All right, good. So let's just go ahead and let's take a look at the discussion here, professional standards. Okay. And they list out the professional standards for us. What is that little thing that looks like a target? I don't know why I have to have that there, but okay, whatever. That's not in the book, right? I don't know why they're having that. Some reason Zoom's got little targets on there now. Anyway, it doesn't matter, John. Forget about it. Ignore it, right? Okay, so we start to take a look at the standards, and the way the standards are organized. Let me put this into full screen. Maybe that'll get rid of some of that. The way the standards are organized, you can see that there are different standards that are used for non-issuers versus issuers, the audits of those entities. Okay, non-issuers are non-public companies. Okay, non-public companies, and for non-public companies, the American Institute of Certified Public Accountants is the entity that issues the standards. They issue them chronologically, and they call them Statement on Auditing Standards, but then they go and they codify those standards. And so they codify them by subject. And so tonight, we'll be talking about the audit standards for reports, and those are all the SASs that have been issued chronologically that pertain to reports are all grouped in one section, and that's called AUC. C is for clarity. They had a clarity project some time back, and they were thinking that that C would be temporary, and then they ended up just keeping it for the codification of the auditing standards. Now, when you do your research, you will have to say AUC, and then you're going to have to find the particular area of AUC where the answer pertains to whatever the subject matter is that's part of that task-based simulation. So if they're asking you something about audit, you can get easy points just by choosing its AUC, okay? PCAOB, Public Company Accounting Oversight Board, which was created by Sarbanes-Oxley, is the entity that's responsible for issuing standards that pertain to issuers. Issuers are public companies. Now, when you look at this, it would give you the belief that there's a whole different set of standards for public versus non-public, audits of public versus non-public companies, and that's not quite the case. What happens is PCAOB standards, which by the way are abbreviated AS, PCAOB standards point to the SASs to a large extent. So basically what happens is PCAOB standards say, if you're auditing a public company, do much of, if not all of, what you would do when you're auditing a non-public entity, but then we're going to add some additional requirements if you are auditing a public entity. And the classic example is that if you're auditing a public entity, an auditor needs to give an attestation on management's assertions about the internal control. That is necessary for a public company. It is not necessary for a non-public company. So the PCAOB comes in their audit standards and talk about the work that you need to do when you're giving an attestation, an opinion on the internal control of assertions made by management in their internal control report. So really PCAOB adds on to SAS. Now, we'll talk more about the internal control reporting requirements in later chapters. I think it's A5, but I'm just using that as an example here of how PCAOB adds on to the SAS standards, PCAOB for public companies, SAS for non-public companies, okay? Now you come over and you have generally accepted government auditing standards issued by the Government Accountability Office, GAO. The office that I worked for 26 years, writes the standards that are applicable to audits of organizations, that government entities, federal agencies, like when I was involved in the audit of IRS and the audit IRS financial statements, we follow GAGAS, but also entities that receive federal financial assistance are subject to audits according to the GAGAS standards. So state and local governments that receive money from the federal government, not-for-profits, which they don't really mention here, not-for-profits, but entities that receive government funding, not-for-profits receive a ton of federal money. And so when you audit a not-for-profit entity, you would follow the GAGAS standards. They are also called the yellow book standards because the cover of the book is yellow. Somebody at one point in time had said, that the auditing standards issued by the GAO should be the gold standard of audit standards. And, people kind of rolled their eyes and says, well, why don't we just not call it the gold book? We'll call it the yellow book. So it doesn't sound so presumptuous. Okay, so it's the yellow book. It's GAGAS. They're issued by GAO. As I said, we'll get into that in Audit 6. I think that's the class where we talk about GAO standards and audits under the Yellow Book. But again, the GAO standards, point to SAS and say, do what you're going to do if you were auditing a non-public company, for-profit company, and then we're going to add some additional requirements on top of that. And so that is the case also with the yellow book. So these three here are really standards that are used primarily for financial statement audits. Okay, now these days quite a bit CPAs, auditors are called on to give assertions about attestation, I should say, about things other than the historical financial statements. So when we do an engagement where we're giving an attest on something other than the historical financial statements, then we have to follow the statements on standards for attestation engagements. Those have the section reference ATC. And again, we are seeing that we will have procedures that we'll be doing on other types of engagements where we're giving a attestation on something other than the basic financial statements. That's when the attestation standards come in. And again, we'll get into that in later chapters. Now, sometimes an auditor could be asked to not provide a positive assurance on a set of financial statements. They may be asked to give a negative assurance, and we'll talk more about this, I think, in Audit 2 when we get into this. Or they could be asked to not even give any assurance at all. Okay, so we call things that are less than the assurance that is given in an audit, which is a positive assurance, negative assurance, or no assurance at all. We call those unaudited financial statements. So we're back to unaudited financial, we're back to financial statements now, but now we're not auditing those. And we use statements on standards for accounting and review services. And you can see the section referenced there, ARC. We're back to the AICPA once again here. So AICPA also sets the standards for the attestation engagements as well. And then these code of professional conduct, the AICPA writes that. Those are abbreviated ET. And it's kind of interesting because they say, oh, if you're a member of the AICPA, you have to follow these standards. And I think to myself, oh, okay, great. Well, if I don't want to follow those standards, I just won't become a member of the AICPA. The problem is that the state boards of accountancy point to their codes of professional conduct mirror what the AICPA's professional code says. So if you want to keep your license, you're going to have to follow the AICPA's code of professional conduct anyway. Okay, and then statements on quality control standards, again, coming out of the AICPA, and they really talk about how the CPA firm should be organized to ensure that their audits are following standards. And in the state of California and in many other states, I'm sure, CPA firms, individuals doing audits are required to come under a peer review. A peer review is when a CPA firm of similar size and business volume go in and do a peer review of another CPA firm, for example, and I don't know if this is the case, but for example, PwC will do a peer review of EY because they're peers, they're of equal size. And what happens is the state societies say, well, when that peer review is done, you will follow the quality control standards of the AICPA to see if the quality control system is following those standards. And you literally, in order to be a entity that can give peer reviews in the state of California, you actually have to register with the AICPA to be able to do that. So those standards are applicable to peer reviews. Okay. Okay, good. I don't think you need a flashcard or anything like that on this, guys. Just a quick overview of the standards. just know that you do practice with these standards in your task-based simulation. When you have to do your research, you'll have to know that you have to know how to search around to find the correct citation for those. Okay. Okay, good. Now there are other guidance for audits, okay, but the most authoritative is going to be the SASs and the PCAOB. There are other things, interpretive publications, other auditing publications, etc. I mean, you can get down to a textbook somehow being authoritative if there was nothing that was up here in the PCAOB and the SAS standards. So most authoritative are the PCAOB and the SAS standards. So let's go ahead and look at this question, and I'm going to put it up. It's a little bit of an annoying question because it's too easy. Okay, no polls or quizzes created. Okay, so does that mean I have to go? Oh, no, that means I can create it here. So hang on, guys. I like to do things to me sometimes. Okay. So let me tell you to make your best choice. And let me see if they're going to let me edit those. A, B, C, D. I don't know why they want me to. Does anyone know what required versus show dropdown means? I don't know what that means, so I'm going to leave it alone, see if it'll let me save it. Okay, and now I can go back to the PDF and hopefully choose the poll. Okay, and watch it. There you go. Okay, so let's look at this question. Can you hear me?
Yep.
Yeah, now we can.
Okay.
Yes.
I'm having another one of those. I'm having another one of those. I'm having one of those lives.
Professor, I don't know if you're speaking or not, but I can't hear you.
I can't hear you either. We still can't hear you. I think you're connected on 2 devices and the other one is where you're connected via audio. I could be wrong, but
Can you hear me?
Yes.
Okay. Hopefully, well, I still have to put it in tablet mode, and that's always, I don't understand why going to tablet mode should do anything to the system, but that's always the scary thing. So before I do though, let's just look at this question here, which most of us got correct. Okay, and you can see here that most of you got it correct. It's 70% chose C. Now, some folks chose A, and I think the reason was that you kind of got pulled in by the fact that they were calling out the AICPA. The AICPA has a lot of guidance that they provide. It is authoritative, but the most authoritative is the general guides provided by Statements on Auditing Standards, which are issued by the Auditing Standards Board of the AICPA. So the correct answer here was C. Okay. All right, good. Let's go ahead and see if I can flip us down into tablet mode without losing the whole world here. Okay. I think we're still here, so okay, we should be okay now. It seems like I have to go through that every time. Okay, good. Now here we talk about audit engagements a little bit, and you know, there's really not much to this section, but we're going to go through and take a look at a couple things. This overview, audit process overview, I don't know that this graphic in particular is very useful, but it is important to note that when you look at a question, try to understand what part of the engagement you're on, and sometimes that helps with the question, because there are some things that we do in the very beginning versus things we do towards the end of the audit, and sometimes it'll say the auditor should do during planning, and then they'll have something in there as a choice about a final review step or something, this analytical procedures that are done at the end of the audit. So it is useful sometimes to know where the question is saying you are on the audit. That is helpful. It won't be so helpful for tonight's class, because notice we're talking about the reporting, which comes at the end. So we're starting at the end of the engagement here in our discussion in A1, and then we're going to go ahead and start to turn our attention to the planning part, probably about A3 or so. We start getting into, you know, the engagement acceptance and whatnot. So, you know, we'll go back to the beginning, if you will, a little bit later, but we're going to be talking about reports in our first couple of classes. Okay. Then you come over and we start talking about the independent audit function. And when we look at this, you know, it's worthwhile to even understand, well, why do they even call this an audit? Well, you know, CPA firms have been around since the 1800s, okay? Kind of was an English thing, right? Many of the big four firms, those names are of English individuals. And at one time, because people were sort of, you know, many people couldn't read, auditors would stand out in the public square and say out loud what their findings were. So they were audible. So auditors are to be what? Are to be heard. They call it an attest engagement. An audit is an attest because you are testifying as to what your findings are. Okay. So what happens is auditors do what? They provide an opinion on whether or not the financial statements are prepared in accordance with the applicable framework. For the most part on the exam, they focus on US GAAP. There are other frameworks that are out there. You could have a client that maybe is following IFRS. Well, then IFRS would be the applicable framework in that case. But on the auditing exam, pretty much we're talking US GAAP. Okay, so the auditor then gives credibility to the financial statements because the auditor is what? the auditor is independent of the client. Management is responsible for preparing the financial statements. Okay, so the financial statements are not prepared by the auditor, they are prepared by management. Auditor comes in, independent, third party, and gives an opinion which adds credibility to the financial statements. So then users know that they can rely on that opinion and rely on those financial statements for making investment and credit decisions. So management prepares the financial statements, and they also have to design and maintain the internal controls. The internal controls, of course, will help detect misstatements in the financial statements. Okay, now let's take a look at the auditor's responsibilities here, and the auditor has to maintain professional skepticism. Okay, now when we talk about professional skepticism, okay, auditors should remain alert for audit evidence that contradicts other audit evidence obtained. Information that calls into question the reliability of documents, conditions that indicate possible fraud, circumstances that suggest the need for audit procedures. Okay, so really, when you think about this, what happens? We're talking about evaluating the veracity of evidence. So we get evidence, we make inquiries, we look at documents, and when you get those inquiries and you get the answer to those inquiries, you get those documents, you should look at those with professional skepticism to say, well, can I rely on this evidence? So you're really evaluating evidence there. You know, I was not the best person with spreadsheets and that kind of thing when I was an auditor. I wasn't very good at, using software and that kind of thing. My strength was that I could hear something was wrong when I would know something was wrong when I would hear it. Somebody would say something to me and I'd be like, that doesn't sound quite right. Let's follow up on that and let's look into that. And that's where many of the findings that I was pretty good at developing in the years that I was an auditor came from having, a good professional skepticism. So you're really evaluating evidence when you are exercising your professional skepticism. Now you come down and you can have impediments or impediments to the professional skepticism. And let's go ahead and let's take a look at what some of these are. Unconscious human bias that may cause the auditor to evaluate and recall information that favors the interest of the client over the interest of the investor. In other words, what? You want to keep the client. And so you start looking more sympathetically at the client. Maybe it's your only client. Maybe it's one of your 2 or 3 clients. You don't want to lose them. And you're not intentionally doing this, but you subconsciously start to have biases that favor the client. Development of inappropriate level of trust or confidence in management. This happens when you really are on an audit engagement for a long period of time. You start to know folks so well that you lose your objectivity. One time I was on an engagement where we were looking at customs. The customs part of the Department of Homeland Security used to be a separate agency called Customs. And so we were looking at customs. GAO was looking at their collection of fines and penalties. And when we went, they had the Customs Inspector General. So over each federal department, there's an Inspector General, and they invited the Inspector General in to talk to us as well. And the Inspector General kept saying, well, we do this, we do that, talking about what Customs does. Meanwhile, they are supposed to be what? At arm's length. They're supposed to be auditors. And I was thinking to myself, they have lost their objectivity to a certain extent because they keep saying we instead of they. And that can happen when you have a client that you've had for a long time. Okay. And then again, pressure to avoid negative interactions. Hey, you want to keep the client, and so all of these could be impediments to acting with professional skepticism and also workload demands. Okay. Now, when you look, we're supposed to follow ethical requirements. And as I've said, most state boards of accountancy have adopted the AICPA's ethical requirement, ethical code. They don't explicitly say we have adopted it. When you read, say, the state, and I really just know the state of California, when you look at the state of California's code of professional conduct, it mirrors in many ways what the AICPA code of professional conduct has. Okay. Now you come down and we talk about the use of judgment, and nothing replaces professional judgment. Be careful, guys. There's always a few questions in which they're saying, well, the auditor should share their judgment with management about blah, blah. And you see the word share and you think, oh boy, my mom always told me to share. That's probably the right answer. Meanwhile, you do not share judgments, okay? The auditor makes professional judgments about these various factors that you see listed that we'll be talking about in some later chapters, okay? Now you come down and when we are getting assurance, we are getting reasonable assurance, okay? Reasonable assurance is a high level of assurance, but it is not absolute. So we cannot say, hey, if my opinion is incorrect, you can, kill me, okay? It's not an absolute assurance. It is a reasonable assurance. We say reasonable because there's always a chance that perhaps we've been outsmarted by a client, or hey, we did the audit correctly, but we just didn't find a particular material misstatement. It can happen. And when we look at the opinion, you're going to see now that they give a little speech about reasonable assurance now in the actual audit report. Okay, so it's reasonable, not absolute assurance. Okay. Now you come down and by the way, guys, if this is your first time sitting through a class with me where I'm highlighting the book and stuff, and you see me going past some things, there is a chance that you might see a question or two that relate to things that I didn't talk about. Maybe I'll show you later. You can always go to the lecture. In the question, it'll say see lecture, and it'll take you to the part of the book where they discuss that. You may want to add a flashcard or two to that if I don't necessarily address it, because I'm trying to get you a good 80%. There may be some things, that I don't talk about that you might see one or two questions on. So sometimes I'll go past things. It doesn't mean you won't see questions on them. It just means that I've made a judgment call here that it is better for us to, not spend time with some of that stuff. Okay, good together here, but that doesn't mean you shouldn't look at it. That doesn't mean you won't see a question on it. Now we have non-issuers, okay, which are what? Are non-public companies. And we have issuers, which are public companies, okay? And the big difference these days is that not only do we give an opinion on the financial statements, we also give an opinion on the internal control, okay? With the non-issuers, it is just an opinion on the financial statements, and there is no opinion on the internal control. Now, that doesn't mean that we couldn't be engaged to give an opinion on internal control for a non-public company, but it is not required that we give an opinion on the internal control, whereas for public companies, you have to give both. Okay. Okay, good. Now you come over, so there's a choice there if you want to do the internal control. Okay, now you come over. When I say choice, they engage you to do it and they pay you to do that work. They engage you to do that work. But if they engage you to do the work on internal control, they also have to engage you to do the work on the financial statement. So if they do engage you for that, those audits have to be integrated. We'll talk more about that in Audit 5. Okay. Now, the objective of the financial statement audit is to obtain, is to apply the standards and to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether caused by error or fraud. Okay, error is what? By accident. Fraud is intentional. Okay, and then we are to report our findings in a written report, and we're going to be looking at that quite a bit here today. Okay. Okay, good. Come over, and when we have the work looking at the internal control of financial reporting, now we are expressing an opinion on the company's internal control. And again, that you have, if they engage you, if they ask you to do that work for a non-public company, that's fine. And we'll talk about the standards around that under the attestation standards, as I said in Audit 5. For a public company, you must provide this opinion on the internal control. Okay. Okay, good. Let's take a look at this question, and hopefully we won't have nearly the battle that we had last time to launch this poll.
Professor, are you going to put the poll up?
I'm seeing it on my screen.
I don't see it on mine, unless I'm missing it. Does anyone else see it?
Nope.
Oh, I had the poll.
Well, we already submitted it, but I
Yeah, if
don't
you submitted it, it goes away.
Okay, I didn't see it, so I didn't submit it.
Okay. Well, let's see, maybe something happened on your end, but let's see if that persists tonight, maybe for the next
Okay,
one.
thank you.
What do you think the answer is? You want to tell us verbally?
I'm gonna take a leap and go A.
Okay. That's not right, but thank you.
Okay,
Thank you for being brave.
no problem.
Let me go ahead and end the poll. Okay, make your best shot, but let's look at this. And guys, I'm seeing a little bit of a trend here where, well, one person, we know why they didn't answer, but make sure everyone's paying attention and trying the poll. Okay, but most of us, well, we're all over the place on this. The largest percentage, the 40% on C, is correct. So not most of us got it right because we're under 50% here, but those who chose C were the majority here, and not the majority, but the biggest percentage. Anyway, but let's take a look at this one together because it looks like this is a little bit of a tricky question. Okay, so which of the following is not an example of the application of professional skepticism? Okay, well, let's first think about what we're doing with professional skepticism. And as I said, we're getting evidence, could be oral evidence through inquiry, could be documentary evidence, etc. And we are what? We're getting that evidence and we are assessing, evaluating the veracity of that evidence. Okay, so we just don't take something and say, oh, well, they told us this, so it must be true. No, we are trying to see if we are actually satisfied with the evidence that we're receiving. Okay, so when you look at the first one, A, design additional procedures to obtain more reliable evidence in support of a particular financial statement assertion, that is not correct, because when we're looking at what? Professional skepticism here, we are trying to get what? Additional evidence. It is related to evidence and we're looking for more reliable evidence. So that would be an exercise of professional skepticism. Obtaining cooperation of management's explanations. Again, now this is what? Oral evidence, but we're looking for something else that will corroborate what management has told us. So no, that would be professional skepticism. Using third-party confirmations to provide support for management's representations. Again, management is maybe putting in writing or saying something, they're making representation to us, but we're looking for a third party to what? To help us to evaluate the veracity of that evidence, okay? So C, inquiring of prior year engagement personnel regarding the assessment of management's honesty and integrity, that's giving us a sense of what we have going in, but it is not having a piece of evidence and trying to evaluate its veracity. So C is not an exercise of professional skepticism. We may very well do that, and it's setting the scene for us as to how reliable management is and whatnot and how honest we think they are, but it is not an exercise of professional skepticism where we have evidence and we're trying to evaluate that evidence, which was the case, the veracity of that evidence, which was the case in A, B, and D. Okay. Okay, a little bit of a tricky question, but let's go ahead and let's take a look at our next module here, module 3. And let's take a look now at the opinion on the financial statements. Okay, so again, keep in mind, guys, even though we're in chapter 1, this comes at the end of the audit. After we've done all that work, obtained all that evidence, did all the planning, etc., then we come in and we're going to provide this opinion report that we're going to be studying here really for the balance of the class tonight. Okay, so you come over and we start to talk about, and I always call this the grapefruit. Here we have these this chart here that gives us all these different types of opinions. Okay, now I'm going to use a highly technical drawing here to help you understand the emotion of the auditor for each one of these opinions. Okay, so unmodified opinion is what we do for non-public companies. For public companies, I'll just put pub there, okay, we call it unqualified. But in terms of the emotion of the auditor, they are the same. Here's my highly technical drawing. The auditor is happy. That's saying that the auditor has looked at the financial statements and says, you know what, they are in accordance with the applicable framework, probably US GAAP. You can rely on the information contained here. Okay, that's called an unmodified for non-public, unqualified for public companies. Okay, now you notice that we have these different colors, yellow and red, I guess, or pink grapefruit here, as we get to both sides of the graphic here. And this side is if we have GAAP issues. So what happens? Generally accepted accounting principles say you're supposed to account for leases a certain way, and they don't follow the rules. Okay, if that's the case, then we will give a qualified opinion, meaning that the auditor is sad. Okay, the auditor is not happy about that particular issue, and we will call that out in our report. So we will say it is qualified. Okay, so this gets a little funny because you have to kind of get used to this, because if you're looking for a job and they tell you you're qualified, you're happy, right? If they tell you you're unqualified, you're sad. Well, when we're talking about the opinion on the financial statements, it works the other way. If it is qualified, then we're sad. If it's unqualified, the auditor is happy. So there's one thing maybe that we're not happy with, okay? Now, when we go from qualified to adverse, the auditor's emotion goes from sad to what? To crying, okay? Now the auditor is not only sad, the auditor is crying. They're saying there's so many things wrong with these financial statements. It's very material, very pervasive. There are several problems, or there's one huge problem that is so pervasive. Investor, creditor, do not rely on these financial statements. We don't like it at all. They've messed up. Management has messed up, okay? Now, the chart only goes one way or the other, okay? So when we get to audit issues, now there's some audit procedure that the auditor could not perform that caused them to want to give either a qualified opinion because of gas issues. Sounds funny, I know. We're going to get my sophomoric, laugh out of the way. Gas issues, right? Audit issues, gas issues. And again, if it's qualified, the auditor is what? The auditor is sad. And if it's a disclaimer of an opinion, I'm not going to even put the mouth on the auditor, because the auditor isn't saying anything. They're saying, I'm not giving you an opinion on these financial statements. Okay. Now let's just use a silly little example here. Okay. Let's say your friend calls you and says, hey, I have a job interview tomorrow, and I would like for you to come by and see what you think of the outfit I'm going to wear to the job interview. So your buddy comes out, suit, shirt, tie, shoes, they nailed it. You say, I don't know what you're going to be saying in that interview, but if they judge it just on your clothing, you're in, you've got the job. You just gave an unqualified opinion, an unmodified opinion on their outfit. You're saying you look good, okay? Now, let's go over to the gap issue side. Let's say your friend comes out, the suit and everything is perfect, and then when you get to the shoes, they're wearing a pair of Air Jordans, and you say, what are you doing? You can't wear those shoes to the interview. They say, well, I want to show that I'm energetic and fast and I can, really run around the office quickly if I have to. No, you say your outfit looks fine except for the shoes. And you would give an opinion that calls out the thing that you're upset about, okay, that you don't like about the outfit. Now, when you go from qualified to adverse, things go from bad to worse. Let's say your buddy comes out in a full sweat outfit, a very nice sweat outfit, one of them kind of velvet looking ones, but you're saying, no, you can't wear that to the job interview. Are you crazy? They're going to call security on you if you show up there. Now you've given an adverse opinion. Okay. Now that's on the gap side, and notice that what? Our problems go from not as pervasive, just the shoes, to the whole outfit. Okay. Let's look at the gas side, audit issue side. Okay. What happens? Your buddy comes out in the outfit. If it's beautiful, you give them unmodified, unqualified. But let's say now they come out and they don't have any shoes. Very nice socks, no shoes. And you're like, well, what shoes are you going to wear? They say, oh, I'm going to pick up the shoes on the way to the interview. And you say, okay, well, your outfit looks fine, except for what I would be able to tell you about the shoes if you had them here for me today to see them. Okay, that would be a qualified. Disclaimer would come up if your buddy says, hey, what do you think of my outfit for my job interview tomorrow? And you say, well, I'll be right there. They say, no. Just tell me from the sound of my voice, how does my outfit look? And you say, I don't know. I disclaim an opinion. How the hell can I tell you how your outfit looks from the sound of your voice? Okay, that's what a disclaimer does. Now, we don't see adverse opinions very much. We do see disclaimer, okay, where there's so many problems that the auditor finally says, I can't give you an opinion on the financial statements. For example, the federal government, okay, receives a disclaimer of an opinion on every audit. Okay, so here's the first annual report of the federal government that was some years back. Okay, getting longer and longer. I was involved in that audit. And even though this looks fancy, look at that Statue of Liberty and everything, this has a disclaimer of an opinion on the financial statements. Okay, there's a disclaimer of an opinion. Now, why did the GAO disclaim an opinion on the consolidated financial statements of the federal government? And by the way, continues to do so. Well, there's a couple problems, or maybe a couple hundred, okay? The first one I'll talk to you about is no one can audit Department of Defense. Why not? No one can get a clean opinion on Department of Defense. How come?
Everything's classified?
Thank you for stepping into that. That's not the reason, because a person can get the clearance that would allow them to audit the Department of Defense and see all the classified things. They call that a Q clearance. One time they came to me and said, John, we want you to get a Q clearance so you can be involved in Department of Defense audits. And I was like, well, what is a Q clearance? Well, they're going to talk to all your former friends and stuff. And I was like, no, I don't think so. No, thank you. I don't want no Q clearance. I don't want people cracking into my life to that degree. So I wasn't interested in that, but you can get the appropriate clearance. The problem, Kathy, is that the Department of Defense isn't good at keeping track of their assets. They're good at blowing up other people's assets, but they're not good at what? At keeping track of their own assets. And so every year, Department of Defense gets a disclaimer of opinion on their financial statements. And then because Department of Defense is a major subsidiary of the entire federal government, right? That disclaimer on this major subsidiary bubbles up into a disclaimer on the overall financial statements, the consolidated financial statements. Now, sometimes students are like, why are you getting into that, John? Because you will probably see in your homework a question that'll say, what would cause a disclaimer on the consolidated? And probably the correct answer is going to be what? A major subsidiary has a disclaimer, and that's how that bubbles up into disclaimer on the consolidated. The other reason GAO, big reason the GAO disclaims an opinion on the consolidated financial statement of the federal government is the balance sheet doesn't balance. The balance sheet doesn't balance. So why doesn't the balance sheet balance? When people say because of the deficit? No, because they have a screwed up system in which they have one system that prepares the consolidated statements, and then they have another 20-something, 30-something systems for each individual agency. And then they try to reconcile the two. And guess what? It never reconciles. There are transactions that are dropped between the individuals and the consolidated that lead to a problem in which the balance sheet doesn't balance. And there was always this running. It was very annoying. We'd have to sit there and pretend like we were going to finish the audit, waiting for Department of Treasury to say, okay, we can't balance the balance sheet, and then we'd all go home because we knew, okay, we're going to issue the disclaimer because they can't get the balance sheet to balance. So a lot of issues there, but notice it's very big, pervasive issues that cause the disclaimer, okay? Key thing to take away from this is what? Kind of give you the sense of the words here, but also note that we go to the right, we go to the left, okay? You have what? A choice between qualified and adverse. For GAAP reasons, it's what? Qualified, same word again, and disclaimer for GAS reasons, for scope limitation problems. Okay? Okay, good. Any question on that? Okay, good. Let's come over then and let's take a look at the unmodified for non-public, unqualified for public. And I find it very annoying. Can't they agree? Why can't they agree? Why can't they just call it unmodified or unqualified? What's the big flipping deal here that they can't agree. Okay, but no, they have to have two different names depending on whether it's public or non-public. And again, it's the happy face. It means that the financial statements are prepared in accordance with the applicable framework, probably US GAAP. And again, it's unqualified for non-issuers. It's unmodified for non-issuers and unqualified for issuers, public companies. Okay, all right, good. Now you come over, and when we start to modify our opinions, it can either be qualified, and it can be qualified for what? For GAS or GAAP reasons. Adverse only applies to what? GAAP, and then disclaimer only applies to GAS reasons. Okay, the auditor does not express an opinion on the financial statements. Okay, all right, good. Now you come over and let's take a look at another one of our questions. Are you seeing the poll?
Yep, I am.
I am not. But maybe I have it in different view.
I don't see the poll either.
I don't
Do you
know,
have the-
because I'm seeing it on my screen. And I think the majority of the class on I have a monitor that I use like I'm a student. That's why you see my name twice on here. So I'm seeing it. I would reach out to the tech support folks for Zoom and find out what might be going on there. Or I don't think it's worth rebooting right now, because there's no sense in that, because we'll just ask you to call out your answer. Okay, guys, let's go ahead. I'm going to end the poll. And so take your best shot here, and let's go ahead and take a look at this one. And the correct answer here is B. Okay, so most of us got it right. Good 60% of us anyway got it right. And let's just take a look at this one. Okay, so I'm going to go ahead and take that off, stop sharing that. And an auditor of a non-issuer concludes that a client's illegal act, which has a material effect on the financial statements, has not been properly accounted for or disclosed. Let's just talk about disclosure. Okay, who tells us what needs to be disclosed?
FASB?
Huh?
FASB?
Yeah, right. FASB, you were talking US GAAP, right? Comes down and tells us, hey, you got to disclose certain things, right? So that's a what? That's a GAAP issue, right? How things are to be accounted for is a GAAP issue, okay, and if you have something like an illegal act, that needs to be properly disclosed. That's an accounting issue. If it's an accounting issue, we have to decide between what? Between a qualified opinion and adverse, don't we? For a GAAP issue. Okay, so the answer here is what? Is B. Okay. Okay, good. So what we're going to do now is start to dig in more to the unmodified opinion, but I'm showing a good time for a break here as we enter into module 4, because I don't want to get halfway through the module and then take the break. So we're a little bit early, but I think we're pretty good to go ahead and take the break right now. So we'll come back at what, 6:30, okay, and pick up with module 4. I'm going to pause the recording. Somebody please remind me to start it back up when we come back, okay?
Quick question, should we be flashcarding what you are outlining, or are there specific flashcards that you're going to call out?
I'll call out flashcards. So far, I haven't really seen anything that is worthy of your time to flashcard right now, because right now it's just sort of like introduction, basic things. And I think if you're going to flashcard anything, I'd flashcard the grapefruit, I guess, but I don't even feel that's necessary, because once we've talked through it, you kind of have it, you know, but don't worry, you're going to be getting a lot of flashcard suggestions coming up here as we start to go through the opinions.
Another question of mine is, when a government entity like a municipality issues bond debt, for example, does that make them an issuer? Or because all of a sudden they have, you know, debt that's out in the public marketplace, does that change the audit in any way, or do you have to have?
Generally what happens, and Kathy, I'm not sure how they get around being, well, generally what happens is municipalities and whatnot receive federal financial assistance, so they have to be audited in accordance with the Yellow Book. And the Yellow Book points to the SAS standards.
Okay.
It's
Kind of like all roads lead to something that's pretty similar.
Yeah, but I would say no, in the context of how we're talking about issuer here, they're not considered an issuer. They have to be audited in accordance with the generally accepted government auditing standards, which point to SAS. There are some callouts, and the reason I hesitated, there are some callouts of PCAOB standards, but I think those are things where the GAO has specifically called out, we want you to do these things from the PCAOB requirements. I know that they are not considered issuers because federal, state, and local governments do not have to have an opinion on their internal control.
Okay.
Which to me is complete nonsense. Yeah, I mean, here it is public funds, and yet they don't have to get an opinion on their internal control, which to me is idiotic. And so maybe someday the federal government, the state and local governments will find courage and have a requirement that they too give an opinion on internal control. I find it a little annoying that the federal government thinks that they can tell public companies to do this and then they don't have to do it themselves. But I think the story, the embarrassment would be so significant that they just can't, they're not ready for that. They haven't, you know, they haven't, they probably need to go see a psychiatrist first before they'd be willing to admit that about all their problems.
Okay, well, thank you.
Yeah. Mm-hmm. Okay, guys, I've resumed the recording, and we're going to go ahead and pick up now with the discussion, digging more into the unmodified opinion. And again, a little annoying that if we're talking about a non-public company, we call it unmodified. When we talk about public company, we'll call it unqualified. We're going to sort of go through talking about the requirements for non-issuers, non-public companies, and then public companies as we go through the various reports. You know, when we start getting qualified, we'll use that same pattern. Okay, but let's just go ahead and let's take a look at the report for the non-issuers, the unmodified opinion. Again, they go through and they give quite a bit of detail here about what is in that report. And I find that by the time I'm done looking at all that, I might as well just look at the report. I mean, that listing of things that they talk about there is almost longer than the report itself. And so the best approach for getting comfortable with the audit report, the unmodified report, right? This is where the auditor is happy, is to flashcard basically most of the report. Now, I know that that's a little daunting when you hear somebody say, you mean I've got to sit here and memorize this thing like the preamble to the Constitution or something? And my answer is yes, you do. Okay. So this first paragraph, even though it's coming under the heading opinion, okay, the first thing you see is the opinion. And this is new. It used to be the opinion was at the end, and then the public companies had started, PCAOB started requiring that they put the opinion at the beginning, and now the AICPA has gotten on board for non-public companies and say, yeah, put the opinion on the financial statements first. Now that first bit of information I call the intro to the opinion paragraph, and I need you to flashcard that. So you would put on the blank side of the flashcard, what is the intro to the unmodified opinion for a non-public company, and then you should write out that entire thing. But let's take a look at it since I'm asking you to memorize this whole thing. Let's just take a look at it. We have audited the financial statements of ABC Company, which comprise the balance sheet, the related statement of income, changes in stockholders' equity, and cash flows for the years then ended. Generally, we have comparative financial statements 20X1 and 2020, and the related notes to the financial statements. Okay, we don't get too far further in this report, and then next paragraph would be, well, what is the opinion part of the opinion paragraph? In our opinion, the company financial statements fairly present in all material respects the financial position of ABC Company and the results of operation and cash flows for the years then ended in accordance with generally accepted accounting principles in the United States of America. We're talking about FASB requirements. We're talking about US GAAP there. Okay. Then we start talking about the basis for our opinion. So now we start talking about, and you should say in your flashcard, what would be in the basis for opinion paragraph. We start talking about what the auditor's responsibility was. We conducted our audit in accordance with auditing standards generally accepted in the United States of America, GAS. That is referring to the AICPA Auditing Standards Board standards. Our responsibility under those standards are further described in the auditor's responsibility for the audit of the financial statement section of our report, which will be coming later. We are required to be independent of ABC Company and meet other ethical responsibilities in accordance with the relevant ethical requirements related to our audits. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. Okay. Then we start getting into, well, what is management's responsibility? And the reason we put that in there is we want to make it clear. There's no reason I've changed from black to red. The reason we put that in there is we want to make sure that everybody knows that management is responsible for the preparation of the financial statements in accordance with the accounting principles generally accepted in the United States of America, and for the design and implementation and maintenance of the internal control relevant to the preparation of fair presentation of financial statements that are free of material misstatement. Notice we say whether due to fraud or error. So we explicitly call out fraud. Now, we're not saying, and you're going to see that they're going to get into that a little bit more, that we are giving an assurance against fraud, but we are considering fraud as we plan the engagement. In preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about the ability of the entity to continue as a going concern. Auditor responsibility. Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion, which we're in that report right now. We give what? We start going on about how reasonable assurance is a high level assurance, but not absolute assurance, and therefore is not a guarantee that the audit conducted in accordance with GAS will always detect material misstatements when it exists. Okay, material misstatement when it exists. The risk of not detecting material misstatement resulting from fraud is higher than for one resulting from error, as fraud may involve collusion, forgery, intentional omissions, or override of internal control. Misstatements are considered material if there's substantial likelihood that individuals or in the aggregate, they would influence the judgment made by a reasonable user based on the financial statements. Okay, now that's a lot of memorization. And I want you to memorize those paragraphs that I have flashcarded here, indicated flashcard for you. And I don't know if they still say it, but at one point in time on the recording, they used to say, memorize every report. Well, who's going to do that? Nobody. Okay. I just want you to memorize the one report. And then we're going to make some flashcards as to how we tweak this when the situation comes up that we're having to modify the report through qualification or adverse or something. So we just memorize the one unqualified, unmodified report, one for public companies, one for non-public, and then we don't know how to tweak it from there. The reason this is important is I can all but guarantee you that you are going to get a task-based simulation in which they're going to say something like this: your staff wrote the report, tell them what's wrong with it. Or so-and-so over here reviewed your staff's report. Do you agree with the notes that were given about the problems with the report? If you have this thing memorized, that's a piece of cake, that question, because you're like, well, I know it doesn't say that, and I know it's supposed to say this, and they left that out. If you don't memorize it, a question like that can be a time-consuming nightmare for you, okay? So I need you to memorize this word for word, these paragraphs. Okay, now they in my opinion are overdoing it in the report now, because part of the idea here is to get the user to read the report, and then you give them a whole book of stuff to read. At some point the user is going to stop reading. Okay, so I don't know why the AICPA went off in the manner that they did here. But for the rest of these, I'm going to ask you to flashcard elements of these bullets that start to get more into what GAS is all about. The requirement is that you put all these things in here, but I can't see that the examiners are going to give you questions that are going to test the level of detail where you have to memorize this for these additional bullets. Okay, so just have on your flashcard that the additional information about performing an audit in accordance with GAS calls out exercise of professional judgment, that we identify and assess the risk of material misstatement, that we obtain an understanding of internal control in order to design audit procedures, but not for the purpose of expressing an opinion on the effectiveness of the internal control. Thus, no such opinion is expressed. I want you to put that on your flashcard as an additional bit of information that's given about performing an audit in accordance with GAS. That obviously pertains to public companies, non-public companies, not public companies, right? Okay, and then coming down, conclude whether in our judgment there are conditions or events considered in the aggregate that raise substantial doubt about the ability of the entity to continue as a going concern. So we talk about going concern there as well. Okay. Also, we are to communicate with those charged with governance. That's basically the board of directors, certain internal control related matters that we identified during the audit. Okay, still a lot on the flashcard, but you can kind of call out key phrases rather than have to memorize it word for word. Okay, now also flashcard that we have to talk about information included in the annual report, of course, assuming that the entity has an annual report. Non-public companies are not required to generate an annual report, but if they do, then we would have to make some comments about the annual report. And again, I just want you to call out some key things. We have to say that our opinion on the financial statements does not cover the annual report. And I want you to flashcard these things that I'm highlighting here. And in connection with our audit of the financial statements, our responsibility is to read the other information and consider whether or not it is consistent with the financial statements. Okay. And then just note that report on other legal regulatory requirements if applicable. Okay, you don't have to have compliance with other, talk about regulatory requirements. Okay. Okay, good. So flashcard, pretty much that whole report on the first page. Okay, on that page there, page 22, and then get some key words from some of these other bullet items. And I think you'll be in good shape for that task-based simulation question where they're going to ask you to basically look at your staff's draft of the report and tell them whether or not you agree with comments that are made on it or whatever it is. Question? Okay. Note that if an audit is conducted in accordance with two sets of standards, what we should do here, and you may have a company that's getting ready to go public, okay? And so you go ahead and you start conducting audit under the PCAOB standards, even though they're a non-public company. So when conducting audit of financial statements in accordance with the standards of the PCAOB, and it's not required, the auditor is required to also follow GAAS. In addition, you will use the PCAOB report and then amend the PCAOB report to state that the audit was also conducted in accordance with GAAS. So even though you use the PCAOB report, you still need to follow the all the GAAS requirements. Okay. Now you come over, and this gets a little interesting here, and they're basically telling us here that key matters, okay, are selected from matters communicated with those charged with governance. So we're going to see later that there are certain findings that you have to report to the board of directors, okay, and non-issuers have the option of whether to engage the auditor to communicate key matters in the audit report, but should consider the needs of users when making this decision. Now, I find this a little annoying because who is talking to us here? It's the what? AICPA telling companies who they have no authority over what they should be considering when they make a decision to have the auditors communicate in the audit report things that they communicated to those charged with governance. So it's not a requirement. The entity can choose to ask the auditor to include those things in the report. Now, when deciding whether matters, if any, should be reported, the auditor should consider that items that are of higher assessed risk of material misstatement, areas requiring significant auditor judgment, okay, including estimates, and significant events or transactions. And the determination of which matters to include is ultimately a matter of professional judgment. So they're just sort of calling out some suggestions here, but go ahead and flashcard what should be considered for reporting other matters. critical audit matters. Now, the problem are key audit matters. When we deal with public companies, we'll call them critical audit matters. And for public companies, we're going to see that the PCAOB requires the auditor to find a critical matter and report it, which I find annoying. Because I may not have a critical matter, and now all of a sudden PCAOB is telling me, well, go find one. It's like talking to a kid, go back in there and find something again, when meanwhile the kid's saying, but I don't see it, right? So the AICPA called it key audit matters, not critical, and notice they're giving the option as to whether or not these things need to be reported in the audit report. Okay, good. Now you come over and let's take a look at the report now for unqualified reports, what we call it, for public companies, okay, for issuers. So you come over, okay, and they call it unqualified when we're talking about issuers. So it's unqualified, right, for issuers. Okay, and again, they give us a long table here of things that are included in the different sections. I, again, am going to ask you to memorize the report for the issuers now. Okay, so this is, again, a registered public accounting firm, because you have to be registered in order to audit a public company. Okay, with the you have to be registered to do that. So we have an opinion first, okay, and go ahead and flashcard that basic combination of the opinion and the intro paragraph. Then we have the basis for the opinion, and that is going to be a paragraph that you are going to flashcard and memorize. Notice here, guys, we do what? Now we're calling out the PCAOB as the standard setter. So when we're talking about the non-public company, we say standard generally accepted in the United States of America, which is talking about the Auditing Standards Board standards. In the public company report, we call out the PCAOB, okay? Then we must have a critical matters discussion here. And again, I find this annoying that they are pushing the auditor that you have to have this critical matters paragraph. I don't know, shouldn't I be allowed as an auditor to decide whether or not I have something that's a critical matter that I want to call out in my report? They require it for non-public companies. Note that this critical matters does not change opinion. So you call out this critical matter, you have to, but it's still an unqualified opinion here, okay? So they say that down here. I don't even know where I wrote that there because it's right there. It does not change the opinion, okay? When I teach my class at Stanford on for non-accountants about accounting, intro to managerial, I use the Apple audit report as an example, and Apple has in there an uncertain tax position that they've taken as a critical matter. And again, I'm like, well, why is that a critical matter on the audit if it's relating to the tax issues? But again, they had to come up with something. And so that's what they had in their report. Okay, so you come over and let's look a little bit more at what we're saying here about the critical matters. And the auditor must report any critical matters arising from the current period audit of the financial statements, or state that the auditor has determined that there were no critical matters. But then they keep going and they say it is expected in most audits there'll be at least one. Well, okay. Thanks for telling me that I don't have to have one, and then telling me if I don't have one, I'm an ass. Okay, so they're telling you, pretty much find one. Okay, so go ahead and flashcard that. I just find that a little annoying that they said you've got to find one, essentially. Okay, now you come down And for each critical matter identified, okay, you're going to have to identify the CAM, description of the principle considered that led the auditor to determine the matter was a CAM, description of how the CAM was addressed, and reference to the relevant financial statement disclosures. I guess that's iPad is the mnemonic here, although I'm not in favor of mnemonics for the most part. They use a lot of mnemonics in the audit class, and I don't believe in them. I don't believe in mnemonics. I just want you to flashcard what I want you to flashcard and memorize it, know it, and don't start to clutter your brain up with mnemonics. Okay. Okay, good. Now you come over and let's look at the documentation that we would have to have to support our discussion of the critical matter in the public company report. And something you will see consistently, guys, when we start calling out documentation requirements, I'm almost always going to ask you to flashcard that. I think it's like 99% of the time I ask you to flashcard documentation requirements, because that's very common on the exam for them to expect you, and I think reasonable for them to expect you to know how you have to document certain things. Okay. And so for each matter, it was communicated to the audit committee and relates to accounts or disclosures that are material to the financial statements, and the auditor must document whether the matter was determined to be a CAM and the basis for such determination. So just go ahead and flashcard what the documentation is. Requirements are. Okay. Okay, good. So let's go ahead and let's take a look at our multiple choice question. You know what? Go ahead, work this one. I hate this question, but go ahead and work this question, then I'll tell you why I hate it.
Did you put up the poll?
Oh, I did not. This time I didn't put it up. Okay, guys, I'm going to go ahead and end the poll here. And okay, 50% of us got it right. But this is really, I have a feeling that the AICPA released this question. The American Institute of Certified Public Accountants writes the CPA exam, and they probably released this question some years back because it's a stupid question and probably everybody misses it. And so they stopped, asking this question on the CPA exam. Once a question is released, they'll never ask the question again. And what happens is Becker has fallen in love with this question because they think it's testing, some sort of, squishy area that the candidate would have to exercise some amount of judgment on to be able to answer. Meanwhile, I just think it's a stupid question. So when financial statements contain a departure for US GAAP, because due to unusual circumstances, the statements would otherwise be misleading, the auditor should express an unmodified opinion because we don't want financial statements to be misleading. So even though they're not following GAAP, still issue an unmodified opinion because our ultimate goal is for the financial statements not to be misleading. But when I went back to Becker, when they first put this question in there, and I'm like, do you have an example of when this happens? And then nobody can give me an example. And I asked the question 50 times. And I'm like, well, if you don't have an example of when this happens, I don't think we should be putting this as a question, as a class question, using up a class question. That's just a weird, stupid question. Okay. You're not going to get 100% on the exam. Okay. So if you run into a question, you're like, what the hell? Okay. Do not waste a bunch of time trying to answer that question. What you do is you move on. You take your best shot and you move on. And if it's a completely random guess, I hear people sometimes say, well, when in doubt, choose C. No, you think through in your head. If I'm going to go completely random on this, have I picked a lot of B's so far? Have I picked a lot of C's? And if you have, pick another letter, okay? Because after they write all the questions and they figure out what the answer is, they do an analysis to make sure that there's a random distribution of A, B, C's, and D's. And so you need to, kind of think through your head as best you can. Have I picked a lot of A's, a lot of B's? If you have to guess, if you get a dumb question like this. Of your I believe it is, now I've lost the number. I used to have that memory. 72 multiple choice questions. There's about 12 that are pre-test questions, meaning they will not count towards your grade. They're in there anyway because they want to see how the candidates respond to those questions. And so those questions may not make the final cut of being point worthy. And so don't sit there and waste time on any one question because it may not even be scored. Okay. Okay, good. That's also the case, by the way, for the task-based simulation. There's always one task-based simulation that is not graded. That's why you have to adhere to those time frames that I gave you in the first class as you move through the questions. Do not lock in on any one task-based simulation. Do not lock in on any one multiple choice question. Okay, all right, good. Let's come over then and let's start talking about modifications, okay? And we call them qualified or adverse for both issuers and public and non-public companies, but we are going to see that the report format is different depending on whether we're talking about a public or non-public company. So let's just come over and let's go straight to the report. I don't like these tables that try to sit here and give us all this information here. Actually, I think we can use this. Actually, let's go ahead and make a flashcard out of this. I'm calling an audible here, guys. I think that you can use this. So flashcard this, okay? Because I've asked you to pretty much memorize, again, this is the non-issuer report. I've asked you to pretty much memorize the unmodified report, right? Now we're coming into a qualification, and it's a qualification for GAAP issues. Okay, we'll talk about the qualification for GAAP issues later. Okay, for GAAP accounting issues. Okay, and yeah, this is good because I've asked you to memorize that report, and then this is telling you how you will tweak the unmodified report based on the qualification for GAAP reasons. So I think this is pretty good, actually. It leverages off of our memorization of the unmodified report, okay? So the title would be the same, the addressee would be the same, and then instead of just saying our in the in the unmodified report, we just say opinion. Instead, now we're going to say what? Qualified opinion, right? Okay. And then we will have the heading qualified opinion, okay? And the section should be modified to state that except for the effects of matters described in the basis for the qualified opinion section, and then everything else is the same as what you've memorized. So you're going to say, hey, my buddy's outfit was good except for the shoes. Remember the shoe example? Except for the shoes, and whatever that is that you have a problem. The financial statements are fairly stated, except they didn't disclose something about leases. And then the rest of that report is exactly how you memorize, okay? Then in the unmodified report, then you have the basis for the qualified opinion. You have to put that heading, and it'll give a description of the matter, the reason that you're qualifying the opinion. I don't like the shoes. Okay, so except for the matter described, then you come with the basis for the qualified opinion. I don't like the shoes. The rest is the same. So if you memorize the unmodified report, and then you're being asked a question about how to write a qualified opinion for GAAP issues, that's a piece of cake for you too, because you've made a couple of flashcards about how you should change the report that you've memorized. Okay. Okay, good. So that saves us some trouble, because what you could do when I say make a flashcard out of that, you could shrink that down. You could shrink that down in your copier and just make this into a flashcard right here and save yourself some writing. Okay. Okay, good. So you can see we call it qualified opinion, right? We say except for the omission of the information described in the basis for the qualification, basis for qualified. You just list out whatever the issue is that was described in the problem. They say, well, they didn't disclose some leases. If they wanted you to kind of tweak the report accordingly, that's where you would describe that. Okay. Okay, good. Now, if we are talking about, by the way, they give you, two different examples of a qualified opinion. I don't care what the issue is. There was something wrong. GAAP says put a green elephant on every page of the financial statements. They did not. What do? You put the heading qualified opinion. You say, except for what I'm about to tell you. Under the basis of qualified opinion, you say they didn't put a green elephant on every page of the financial statements. It doesn't matter what the issue is. The pattern is the key, okay, for a GAAP qualification. Okay, good. Now you come over, they give you a second one. I'm not going to look at that, but you come over and let's take a look at what we should do if it is an adverse opinion. And again, we're still talking about non-issuers. For the adverse opinion, when we have GAAP issues, we either go from qualified to adverse, and yeah, so let's flashcard this. Okay, because notice we say the title is the same, the address is the same, but now we say what? Adverse opinion. And notice here, guys, you don't say except for, you say because of. So think of it like in terms of a relationship, right? You have somebody and you say to them, well, except for the fact that you snore, you're a wonderful person, whatever, right? Or except for that time you were mean to me, everything is great, right? The adverse opinion, you're breaking up with that person because you did this and that. That's the reason I'm breaking up with you. Okay, so you could look at it that way. Because is a more pointing word. Okay, then you do what? Then you give the basis for the adverse opinion. Okay, and now they sit here and they say, and you describe whatever the matter is for the adverse, and now they tell us don't have a key audit matters. And I think the reason they're saying that is we don't want to confuse the reader with too much. We want the spotlight to be on how screwed up their financial statements are. We don't want to start getting into a bunch of other matters communicated, etc. Right? And then the rest is the same. Okay, so use that as a flashcard. We don't have to look at the adverse opinion now, because I think that table helps us. Okay. Okay, good. Let's look at the issuers now. Okay, and when we start to take a look at our issuer report, we're going to see the qualified opinion for GAAP reasons. Okay. And what I'm going to do, notice we still use the word in the opinion section, except for, and then we put an additional paragraph that sits there and lists out what the reason is. Okay, so the pattern here is what? Same as the unqualified report, but now we say, hey, except for what I'm about to tell you about. And they don't call it basis for opinion. They just call it what? They call it addition. It's just an additional paragraph that you come out and you talk about what the reason was for your qualification. And then the basis for the opinion section comes in where you're describing the what the work is that the auditor did. And then you have your critical matters. So just flashcard that the pattern is what? In the opinion section, use the word except for, add an additional paragraph that calls out what the problem is, and then the rest is just like you memorized for the issuers on qualified report. Okay, so let's take a look at that just so we can kind of see. There's the opinion, right? And then there's the in our opinion, except for the effects of not capitalizing certain leases. And then there's an additional paragraph down there that describes more details, what's going on. Basis for our opinion in critical matters is what you would have already memorized for the unqualified report. Okay. Okay, good. If it is an adverse opinion, okay, and let's just take a look here. Notice, and you can sort of flashcard this too. Notice that what we use the word because of for the adverse opinion, okay, and then the additional paragraph is simply going to call out the reasons for now the adverse opinion, and you can see that how they gave us an example down there where now we're calling out the reason for the adverse opinion. Everything else is the same as what you memorize for your unqualified. Okay. All right, good. Let's take a look at another multiple choice question. Guys, before we look at this question, I want to make sure it's clear about how the basis for opinion changes when we qualify, because we still have the basis for opinion paragraph, but we include our reasons for our qualifying in the basis of opinion on a qualified opinion, whereas we obviously wouldn't have to say that in a unqualified report. If it's qualified, the basis of opinion paragraph is there either way, but we start to call out what the reasons were for our qualification, right? So it's just important. I want to make sure that you're realizing that. Okay. Okay, good. Let's go ahead and end the poll then, and let's take a look. And just about everybody got it right. There's no wording of subject to. The wording is what? The wording is except for when you have a qualification due to inadequate disclosure. That's a gap issue. And so we would say except for the omission of the information described in the basis for the qualified opinion section. Okay. Okay, good. Now you come down and take a look at what happens when we have to modify. And again, we call them modified for both public and non-public companies because of gas issues now. Okay, and again, the question is qualified or disclaimer depending on the pervasiveness of the issue, right? And again, it would be the difference between your buddy not having the shoes that day and trying to ask you to tell them, you know, what do you think of my outfit by the sound of my voice, right? Okay, good. So you come over and you take a look and they start to talk about scope limitations, okay? And scope limitations mean that I couldn't follow the full scope of what the audit is requiring. And they tell us that the cause of scope limitations could be by circumstance, or it could be by what? By management imposed scope limitation. So what does that mean? Let's say I'm engaged to audit financial statements for the year beginning January 1st, ending December 31st, and I'm not hired until July 1st to do that audit. Okay, what happens? That would impose a scope limitation by circumstance that would not allow me to do a required audit procedure, which is to observe the client taking the ending inventory from the previous year, which is the beginning inventory of the year under audit, right? So because of that, that would be a scope limitation created by circumstance. And I would probably, in that situation, disclaim an opinion on the financial statements entirely because I can't get comfortable with the inventory. I can't get comfortable with the cost of goods sold. I can't get comfortable with net income. I can't get comfortable with the statement of retained earnings. So I'm probably going to disclaim on the financial statements, right? Now, what happens? Let's say, change the situation a little bit. Let's say I am hired on February 1st. Well, now I might approach the client and say, look, why don't we take the inventory today, February 1st, and I can probably do enough audit work to back through a month of transactions to be able to see what the beginning inventory should have been. So I can apply alternate procedure that will get me to where I want to be, and then I could issue unmodified opinion, unqualified opinion on everything. Okay. Now, let's say management says, we're not paying for that. We're not incurring the cost of redoing the inventory at this point in time. We took it December 31st. We're not taking it again February 1st. So then I say, okay, well, if that's the case, management, then that means that we have a scope limitation imposed by management, and you're going to receive a disclaimer of opinion on your financial statements. How do you like them apples? Okay, so again, could be imposed by management, could be imposed by circumstances. Okay, now when you come over and you take a look at the report, okay, the form of the report and how it's going to, before we look at that, I want to point out something about disclaimer of opinion on audited financial statements. And we're going to see this in the context of the non-public companies' financial statements in Chapter 2. We'll look at this more, but they decided to include in Chapter 1 discussion of how you should handle a situation where you become associated with financial statements, but you're not auditing them. If that's the case, you have to issue a disclaimer, and you have to, even though you're issuing a disclaimer, you must do these steps. You must read the financial statements for obvious errors, disclaim an opinion, mark unaudited on the financial statements, and if the client refuses to correct obvious errors, the auditor should add a paragraph describing what the nature is on the departure from GAAP. So even though you're not giving an opinion on the financial statements, you still have to do these steps, okay? And we'll see that in engagements like a compilation and review, and that's in Chapter 2, we're going to see that, hey, we're going to have to put these things in the reports for non-public companies as well. But they just talked about it here in the context of public companies here in Chapter 1. Okay. Okay, good. So let's go ahead and let's take a look and see what the report will look like. Okay. And so what I want to do is go to that table again that they've given us, and for non-issuers, when we are issuing a qualified opinion, now again, this is gas issues, okay, for non-issuers, audit issuers for non-issuers. That sounds, audit issues for non-issuers, but take a look and let's flashcard. Title is the same, addressee is the same. We have qualified opinion, and again, we use the same word, guys, except for the possible matters described in the basis for qualified opinion, okay? Except for what I'm about to tell you about. Then we give the basis for the qualified opinion. It'll say basis for qualified opinion, and you'll still do it like you did in the standard report, but then you're going to add the reason that you're qualifying. The day that I was there, my buddy didn't have his shoes yet. And so that would be the reason. And then the rest is exactly as you've memorized. So you can see the memorization, guys, is really of the unmodified report, unqualified report is the key to then knowing how to deal with these other situations. Okay. Okay, good. Now you come over and they give us a sample, and here's the qualified opinion, they call it. There's the word except for, okay, basis for qualified opinion, and they list what they did. And then this part right here is the same as what's in the unmodified report. And that's what I was trying to say a minute ago, because they say put the basis for qualified opinion, but then we also put the language that was okay for the unmodified report as well when we start describing what the auditor does. And then responsibility of management, responsibility of auditor, and so on is the same. Okay. Okay, good. Now, if it is a disclaimer, okay, and let's flashcard that now, right? When gas problems go from bad to worse, we start disclaiming, okay? And notice that we have to say the auditor does not express an opinion, a statement that due to the significance of the matter described the basis of disclaimer section, the auditor has not been able to obtain sufficient evidence. And we don't say we audited the financial statements. We say we were engaged to audit. Don't say that you audited them because you couldn't audit them. That's why you're issuing a disclaimer. Okay. then the basis for the disclaimer, whatever it is, okay? And key audit matters, don't put it in there because we don't want to confuse the reader, okay? Responsibility of management, okay, is the same. The responsibility of management never changes. Now, this is important. Auditor's responsibility for the audit of financial statements. The auditor should amend the section auditor's responsibility for financial statements to include only the following. And what they're saying to us here is, look, don't start popping off about all the auditor responsibilities because you couldn't exercise them. So limit your discussion to these things, okay? Which is the auditor's responsibility to conduct an audit, a statement that because of the matters, based a disclaimer, the auditor was not able to provide an audit, and a statement the auditor is required to be independent and meet other ethical responsibilities. So they really truncate what you start to put in that really long description of the different things that you're supposed to do, because they don't want the readers to read that and think that you were able to exercise all those responsibilities. And so you can see the disclaimer. Notice they say we were engaged. We do not express an opinion, okay? And then they give the reason here that they're disclaiming. And this one is very similar to the example that I gave you about not being engaged in time to observe the inventory. Management responsibility paragraph doesn't change. Auditor's responsibility, notice how much shorter that has become now, because we don't want to get into calling out all the different things that we were supposed to do. And, so we don't want to confuse the reader to think that maybe we did those. Okay. Okay, good. If it is an issuer report, let's take the approach of flashcarding the table for that. We call it the section of the first sentence, the same as the standard report, but then the second sentence modified to include the appropriate qualifying language. Okay. Additional paragraph describes the reason. There's no heading on it. Same as standard report, except the second paragraph in the section should refer to the paragraph to describe the departure from the unqualified opinion, and then the same as the audit report, standard audit report for the critical matters. So you come over and you take a look, and we have the opinion on the financial statements. We were unable to, well, notice we're going to have the word where is it? In our opinion, except for, okay, again, we're dealing with public companies here now, except for, and then we give the problem that we're having, more description of that. Basis is the same as the standard report, except as discussed above, we conducted our audit in accordance with the PCAOB. You have to call that out, and then you still have the critical matters. Okay, coming down, if it's a disclaimer, let's just go ahead and flashcard all this. Disclaimer, okay, section heading is disclaimer. Words, we were engaged instead of we had audited, right? Reference to the paragraph describe the reason of disclaimer, a statement that the auditor was not able to obtain sufficient evidence, and then the disclaimer of opinion, additional paragraph that will call out the reasons for the disclaimer, and then modification basis for opinion, section heading basis for disclaimer, eliminate our responsibility to express an opinion, eliminate the entire second paragraph in this section, which begins, we conduct our audit in accordance. They don't want you getting into all that detail of what you're supposed to do in an audit, because they don't want the users to think that you're actually able to accomplish that. And then the critical audit matters section would be omitted in that case. And so you can see the disclaimer, and we say that we were engaged to audit, right? And then we say that what the company did not take a physical count, the basis for the disclaimer, they're the responsibility of management, we are a public accounting firm registered with the PCAOB. Second paragraph, take it all out. Take it out. Don't start describing the things that you do in an audit, because we don't want the users to think that you actually did that. If you are not independent, you cannot issue an opinion. And so you say, I'm not independent and I do not express an opinion. Not a whole lot to say there. That's how important independence is. It's really the cornerstone of everything that we do. So we're not going to say too much. Okay. All right, good. I don't think you need all this. I think we flashcarded the key elements there and some of those other flashcards. So let's go ahead and let's take a look at a couple more questions.
You gonna put the poll up?
Yeah, thank you. Okay, guys, I'm going to go ahead and end the poll. So make your best shot here. Okay. And okay, not the best outcome here. The answer is the answer here is B. Okay. And so I don't think the majority got it right. The majority didn't. It's not even the highest selected answer. So let's go ahead and let's take a look at this one a little bit. And we say, under which of the following circumstances would a disclaimer of opinion not be appropriate? Okay, now why do you give a disclaimer? What causes the auditor to issue a disclaimer of opinion?
Scope limitation.
Scope limitation, gas issue, gas problem, right? So we're looking.
Wait, I thought you said, I'm sorry, the disclaimer would be for a scope limitation, not a gap problem. Yeah, I'm sorry.
Gas. I said gas.
Sorry, I didn't hear you right.
Yeah, no, that's all right. Gas issue, right? Gas problem. Okay. All right. So if that's the case, then I have to look for what? I have to look for the one thing that's describing an accounting problem, right? A gap problem. The others are describing a gas issue, and a disclaimer would be appropriate, right? So you start to look at this and you say, you see item A, the auditor is unable to determine the amounts. Well, if I'm unable to determine something, that's a what? Scope issue, isn't it? I'm unable to determine means I can't figure out audit procedures that will help me to understand the amounts sort of with the employee scheme. Okay, let's look at C. The client refuses to permit the auditor to confirm accounts receivable. Well, that's a scope limitation imposed by what? Imposed by management, isn't it? That's a scope limitation if they're not going to let me confirm the receivable. The chief executive officer is unwilling to sign the management representation letter. Well, look, not only am I going to disclaim the opinion, I'm probably going to withdraw from that engagement. I don't know what they would be thinking. I did have an engagement one time where the, I forget what her title was, the director of the House of Representatives Child Care Center said she wasn't going to sign the management representation letter because she didn't want to go on the hook for all the things that are included in the management rep letter. I had to talk her off the ceiling, and then she finally went ahead and signed it because I finally explained to her, look, if you don't sign this, you're going to have a problem because it's written in legislation that GAO is supposed to audit your financial statements, and you're blocking the what the legislation says. So she finally went ahead and signed it. So anyway, choice B, management does not provide reasonable justification for a change in accounting principle. Yeah, you have to, under the GAAP rules, the company has to provide a justification for changing accounting principle. And if they do not provide a justification, then that change wasn't done in accordance with GAAP. And so you would issue a either GAAP qualification or adverse, not a disclaimer. Okay. Question? Okay, good. Let's go ahead and let's take a look at the next question. Okay, let's go ahead and take a look at this one. I'm going to end the poll. Yeah, we did pretty good on this one. You know, when I look at it, I quickly glance through and I'm like, well, they're asking where we should provide information, an ability to obtain sufficient information. And I immediately sit here and say, well, look, it's either A or D, because there is no situation in the audit that changes management's responsibility. So I don't care what scope limitation, what gap issue there is, management responsibility is going to stay the same, right? Okay. And then I look and I'm like, well, look, if I'm not getting sufficient information and I'm basically describing the nature of the work that I do in my basis for my qualified opinion, yeah, that would be the place that I would call out what the problems were, right? Okay. Okay, good. Let's go ahead and look at our last module. I think we'll have time to finish up module 8 or 7, I should say, dealing with emphasis of matter and other matters. Okay, and first we're going to talk about emphasis of matter. Now, what happens with an emphasis of matter? Emphasis of matter is included in the audit report when required by GAS or at the auditor's discretion. An emphasis of matter paragraph is used when referring to a matter that is appropriately presented and disclosed in the financial statements and is such importance that it is fundamental to the auditor's understanding. And we're going to then include it in the auditor's report. And the inclusion of that does not change the unmodified opinion. Okay, does not change the status of the opinion. The fact that you're adding that emphasis of matter doesn't change your opinion. You're just pointing to something that's disclosed. Now, later, we're going to talk in a little while here, in a couple of minutes, we're going to talk about other matters. Other matters are very similar, but now we're talking about something that is not necessarily disclosed in the financial statements. So if it's something that is disclosed, it's an emphasis of matter. If it's something that isn't disclosed in the financial statements, we're going to use the title other matters for that. Okay. Now, what are the report requirements? And again, guys, key is to memorize the unmodified opinion and then understand how to tweak that for different things when they come up. For example, this emphasis of matter here now. Okay, so we have to use the heading emphasis of matter. Okay, and then we have to describe the matter, and then we have to indicate the auditor's opinion is not modified with respect to the matter being emphasized. Okay, okay, good. Now, when are we required to provide the emphasis of matter? Because we can use auditor judgment, or it could be required. Let's flashcard when it is required to describe a justified change in accounting principle. Now, in this case, management has justified their change. So they're in accordance with GAAP because they've justified their change, but we have to call that out in our audit report. So we have to say, hey, they changed from, completed contract method to percentage of completion method to account for the long-term construction contract. And we call that out in an emphasis of matter. Okay. Subsequent discovery of fact that lead to a change in an audit opinion. So after we have issued the opinion, something comes up that says, we should have issued an unmodified opinion. So we're going to say, here's the unmodified opinion because there's a subsequent discovery of fact before our opinion was, say, modified, say, qualified, whatever. Or the financial statements are prepared in accordance with an applicable special purpose framework, other than regulatory, where the financial statements are intended for general use. And we'll talk about more about that a little bit later in this chapter or in chapter 2. But special purpose framework sounds like, ooh, some big deal. Cash basis could be considered a special purpose framework. And we would have to call out in the emphasis of matter paragraph that, hey, this company is using cash basis for their financial statements instead of accrual basis. Okay. Now, use may be necessary. So the auditor can use an emphasis of matter and then give us examples, a major catastrophe, whatever. I don't think you need to flashcard that. I do want you to flashcard when you are required to use it, and then just understand that an auditor could use it for these other reasons. Okay. Okay, good. Now you come over and let's take a look at the other matters paragraph. Okay. And other matters, including the auditor's report when required by GAS or at the auditor's discretion, same thing we said about emphasis of matter, but other matter paragraph refer to matters that other than those presented or disclosed in the financial statements. So now we're bringing up something even though it's not disclosed in the financial statements. Okay. Now, when the other matters paragraph is included in the auditor's report, the auditor should use the heading other matters. Okay. And note that what other matters paragraph use is required anytime the auditor includes a alert that restricts the use of the report. Subsequently discovered fact, which we said for emphasis of matter as well, but if the subsequent discovery of fact is not disclosed, then it would be under the heading of other matters. Did somebody ask a question? I thought I heard a voice. No. The financial statements of prior period were audited by a predecessor auditor, and the predecessor auditor report is not reissued. Somebody else audited last year's statements, and if they do not allow me to show their report alongside my report, then I'd have to add this other matter saying, hey, somebody else audited last year's statements, and here was the nature of their opinion, and I'd have to summarize that under another matters paragraph. Current financial statements are audited and presented in comparative format with compiled or reviewed statements. Compilation and reviews. Compilations have no assurance. Reviews have negative, limited assurance. And so let's say I have a client and I was only able to review last year's statement, but I'm able to audit this year's statements. I don't want the users to become confused to think that maybe both years were audited. So I'd have to put in other matters that says, hey, we didn't audit last year, we only reviewed them, so that the the user doesn't become confused that maybe I audited both years. Okay. Or restrict the use of the report when we're using special purpose, again, except for when it is regulatory report dealing for general use. And that's a little, duh. How can you restrict something if it's available for general use? It's not restricted if it's available for general use. So if you're restricting the use of the report, you don't have to provide that. You can't restrict it if it's for general use. So you obviously wouldn't have to include that other matters. A report on compliance is included in the auditor's report on the financial statements. Okay. So flashcard the reasons when we are required. Okay. And just note that there are reasons where the auditor may include the other matters, and let's flashcard those to describe a reason why the auditor cannot withdraw from the engagement. Okay, you're like, huh? How would that work? Well, look, it says in the Chief Financial Officers Act that the Government Accountability Office will be the auditor of record of the consolidated financial statements of the federal government. Well, GAO can't withdraw from that engagement. It says in legislation, GAO will do that audit. So if it's something like that, you would describe the reasons in the other matters paragraph. Law or regulation permit the auditor to provide further explanation of auditor responsibility. The auditor has been engaged to report on more than one set of financial statements when each set has been prepared in accordance with a different general purpose framework. So you can go ahead and you can flashcard those. I don't know that the exam's going to
I have one quick question. It says back up there where it says use required, a report on compliance is included in the auditor's report. Does that mean that the auditor did the report on the compliance? It's
Which
the
one?
last bullet point under use required. It says
The
a
report
report.
on compliance is included in the auditor's report on the financial statements. And so what's your question?
Does that mean that the auditor did the report on compliance, or is that sort of that other information-y type stuff?
No, basically, the auditor would be engaged to provide a report on compliance. And the report on compliance is instead of being in a separate report, is included in the report on the financial statements. So then under the other matters, we would report on the
Well,
compliance.
this is where you'd put it then, right?
Yeah,
That's what it's saying.
correct.
Okay, I'm sorry. I just didn't understand what they were getting at. Okay,
Yeah.
got it.
If you include it, you don't have to, but if
Okay.
you include it, and that gets a little confusing, Kathy, because under the GAGIS standards, okay, we are required to provide a report on compliance, and the GAGIS standards tell us how to present that, and it's not under other matters.
Got
If
it.
that makes sense. Okay, so it'd be
Okay.
some other report on compliance other than what we're required under GAGIS. General Accepted Government Auditing Standards, the GAO Yellow Book standards. Okay, now if we're dealing with all that, guys, and I probably should have trumpeted that a little clearer, all that was for non-public companies. Okay, if we're talking about a public company, now we call that emphasis of matter and other matters paragraph explanatory paragraph. So we don't call it other matters. We don't call it emphasis of matter. It is simply an explanatory paragraph. Okay. And that explanatory paragraph will generally follow the opinion paragraph. So let's flashcard that because they ask the annoying question sometimes, where is it placed? It's after the opinion paragraph generally, and use of explanatory paragraph is required. Okay, and let's flashcard when it's required. There's substantial doubt about an entity's ability to continue as a going concern. The company needs to evaluate whether they're going to be able to continue as a going concern. And we would have to we would look at that and see if we believe that there's that substantial doubt. And then we would have to include that in our explanatory paragraph. There's been a material change in accounting principle. There's been a change in reporting entity. Reporting entity would be, we have different companies constituting a consolidation than what we had previously in another year. If that's the case, we have a change in reporting entity, and that needs to be disclosed in the explanatory paragraph. There has been a change in the investee year. In other words, we have an investee and they've changed their fiscal year. A material misstatement in previously issued financial statements has been corrected. Other information in a document containing financial statements is materially inconsistent. What does that mean? Well, we have what? We have an annual report, right? And the financial statements are often put in that annual report, probably towards the back. And we look and we see that in the annual report, they're showing a trend of net income going up year over year, right? Because sometimes they'll put those kind of charts in there. Meanwhile, we're looking and saying, well, wait a minute. There's been a period where the net income has gone down significantly. What are you doing? There's a material inconsistency. Now, our opinion doesn't cover the annual report. So we're not going to, in this assumption, the financial statements are correct. So we're not going to be able to modify the opinion on the financial statements. So what do? We issue an unmodified opinion on the financial statements, unqualified, since it's a public company, and qualified opinion on the financial statements, but we put an explanatory paragraph that says, look out for that information in the annual report. It's not right. Okay. Selected quarterly information has been omitted. Supplementary information that is required by GAAP has been omitted. So GAAP sometimes we'll say, well, you have to supplement the financial statements with a schedule of some sort, and the company doesn't do that. Well, the financial statement is what our audit's covering, and the supplemental information is omitted, then we have to go ahead and we have to call that out in our report. So we'd still be issuing an unqualified opinion, but we'd be calling out other information that they should have provided was not. Okay. Our prior year audit report is not presented. Prior year opinion is updated. Last year, we had given a qualified opinion, but now they've shown us the information that allows us to change our opinion from last year of qualified to now this year unqualified. And we'd have to call that out in the explanatory paragraph. Management is required to report on the company's internal control, but such report is not required to be audited by the auditor, and we have not been engaged to do that. I guess that can happen in some weird circumstance, but just go ahead, since we flashcarded everything, just go ahead and flashcard that. Okay. Okay. And again, at the auditor's discretion, we could, may emphasize a matter regarding the financial statements. Those were the required reasons up there. Now you look at lack of consistency, okay? And lack of consistency makes it sound like it's automatically a problem, and it does not have to be a problem. It's just that the company changed their accounting principles. So notice that unless the audit report explicitly states otherwise, the audit report implies that the financial statements are comparable between periods. In other words, they've used the same the same accounting principles period to period. The auditor should evaluate whether the comparability consistency between periods has been affected by a change in accounting principle, and you can still issue an unmodified, unqualified opinion, but we're going to have to first see that the change was acceptable. We're going to look at the rules here, and if they were acceptable, then we simply have to add the emphasis of matter paragraph that calls out the fact that they changed their accounting principles. Okay, so when evaluating, though, the acceptability of the change, okay, the newly adopted accounting principle has to be in accordance with the appropriate framework. The method of the change is acceptable. They've disclosed that properly, that they've changed that accounting principle. And of course, we would have the emphasis of matter describing that. And the entity was justified that the change is preferable. And if the auditor is satisfied with all four criteria, then they can put the emphasis of matter. If it's a non-public company, explanatory paragraph in the auditor report that describes the change. Now, examples of matters that affect consistency, okay? A change in accounting estimate that is inseparable from a change in accounting principle. For example, depreciation method. What happens? If a company changes their depreciation method, some might argue that the change in depreciation method is actually a change in estimate, and therefore doesn't have to be called out as a change in principle. Well, that's not right. Okay, what happens? Company uses declining balance. And if they're using declining balance, they're telling you that the asset depreciates what? Quickly in its early years and slower in its later years. Well, what happens? If they then change to straight line, well, now they're telling you that what? That asset depreciates evenly over its life. Well, isn't that a change in estimate? The auditing standards is telling us no, that's a change in principle, and you will have to call that out as your under your emphasis of matter explanatory paragraph, calling out that as a change in principle. Okay, correction in error. Okay, say they were using an inappropriate method to account for their financial statements before, and now they've corrected that. That needs to be called out in the emphasis of matter other matter paragraph, talking about the change, a change in reporting entity. again, the compilation of entities that make up a consolidation, correction of a material misstatement in previously issued financial statements. All of these are situations that would constitute a change that needs to be called out. If the entity's financial statements include a significant investment accounted for using the equity method, and the auditor's evaluation consistently would include considering if the investee makes a change in accounting principle, how that would affect the consolidator, the parent's financial statements. Okay. Now, if the change is acceptable, important here. So flashcard the examples, but also flashcard other changes in accounting estimates would not affect the consistency. Okay, so you change accounting principle, you change depreciation method, yes. If you change the number of years that you think the asset's going to last, that's a change in estimate that would not require that you call that out as a change in accounting principles. So I thought the asset was going to have a 10-year life. I depreciate it over 10 years. And then after a few years, I decide, you know what, it really only going to have a 5-year life. I would then depreciate the remaining balance over wherever the remaining life was there. I have a change in accounting estimate, and that does not have to be talked about in the auditor's report. Okay. Now, if the effect of the change in accounting principle is immaterial, no revision to the report is necessary. If the effect is material, again, emphasis of matter or other matters paragraph needs to be included in the auditor's report. Okay, and it would be included in the period of change and then in all subsequent periods until the new accounting principles applied to all periods presented. So, once you've kind of worked through and you've been using that new method in all the periods presented for the, then you would no longer have to include the other matters, emphasis of matter, and or explanatory paragraph. Okay. Okay. Yeah, go ahead and flashcard those blues up there. Okay. With the little bit of time we have left, which is none because we're over time, let's go ahead. Yeah, let's look at these couple questions, guys. That way we can finish up module 8, module 7, and we can hit module 8 on next week. Okay, guys, I think we can go ahead and look at this one. Looks like most of us had a chance to try it. Yeah, this is tricky. This is tricky. So only 45% of us got this right. Answer here is D. What's happening? I'm glad that the choices are between C and D, because I think you're getting the point that if the auditor is satisfied and management believes, that sounds like some sort of wonderful relationship. So we know it's going to end up happy at the end, that it's going to be unmodified. But the problem with choice C that many of us selected is it says in the question that what? They have fully disclosed the situation. Well, if they fully disclose the situation, then it's included in the financial statements. And if that's the case, it's emphasis of matter, not what? Not other matters. So C is not correct because it's not emphasis, it's not other matters, it's what? Emphasis of matter. But both of those situations, the opinion would be unmodified. Okay, tricky, huh? It's kind of mean of them. Let's go ahead and take a look at the next question, and then we're going to get out of here.
Can I put the poll up?
It's up on my
You did.
end.
You did. I'm sorry. You know, you did. And I answered it.
Okay. Okay, good. Well, let's go ahead and let's take a look at this one because it's getting kind of late here, guys. So the answer here is C. Okay, most of you got it right, so that's great, especially at this time of night when we're getting probably tired. So you can see that most of us got it right, 80% of us got it right. But let's just take a look at this one. Which of the following events would an auditor issue a report that omits any reference to consistency? In other words, we're not going to have to provide the explanatory paragraph, the emphasis of matter that describes a change in accounting principle, right? Well, look, if you change inventory methods, yeah, you got to provide the emphasis of matter, other matters, emphasis of matter or explanatory paragraph that calls that out. A change in accounting principle that is not generally accepted to one that is, yeah, if you were using an inappropriate method before and you fix that, that's called out in the emphasis of matter or explanatory paragraph if it's a public company. Management's lack of reasonable justification for a change in accounting principle, that will not only have to be called out in the report, it's going to result in a modification, probably qualified or maybe even adverse if it's pervasive and significant enough, right? So yeah, there would be a mention as to the reason. It would be under my basis for my qualification. And then C is the correct answer, change in useful life used to calculate the provision for depreciation. If you change depreciation method, yes, but if it's the life, you said, hey, I thought this asset had a 10-year life and only has a 5-year life, and now my depreciation numbers are going to change, you do not have to modify the report for that. Although management may disclose that in the financial statements, we don't have to modify our report for that kind of situation. Okay. Question? Okay, guys, we will jump in on module 8 next Thursday. Expectation is that you should do your level best to get through the first 7 modules of homework. So I think we made some good progress tonight, and you want to keep that up as you go through week to week. And that I am going to be monitoring that and looking to see that you're completing the homework and staying on schedule with your study plan. Okay. Questions, concerns?
Can I just run a question by you after class real quick?
Yeah, sure. Yeah, I'll go ahead and adjourn the class and stop the recording. Thanks for your patience, guys. I know we went a little late. I try not to do that, but I figured it was worth it so that we could finish that module 7 since we entered it with enough time to potentially complete it. So I will see you next week.
Have a good one. Thank you.
Thanks, bye.
Thanks, guys. Have a good night.